4, 3.
Good afternoon. You're watching the KPMG Africa Conversation series coming to you live from Johannesburg. A warm welcome to our regular CNBC Africa audience and, of course, our international viewers this afternoon joining us via webcast. We're focusing on transacting in Africa in today's conversation, and joining me now for that discussion is Eloise Smith. She's the Executive Vice President, Business Development at Standard Bank PLC. We also have Alan Field. He's Head of Tax and Legal at KPMG, John Gill, Head of Transactions and Restructuring at KPMG, and joining us from our Nairobi studio is Habil Olaka. He's the Chief Executive Officer of the Kenyan Bankers Association. Thank you all for joining me this afternoon. John, let's start with transacting in Africa and the basics. I'm a business in Johannesburg and I want to put together a deal for the African continent. Where do I start?
Yeah. Bronwyn, I think if you're doing that, you're acting on a strategy. So you would have ideally identified a territory, a region, a market that you want to get into for a particular reason. And once you've identified that market, where you'd start is by trying to identify the strategy, either organic growth, going in and starting from greenfield, or going in and trying to do a transaction with an existing entity and buying a stake and using that entity as your launch pad into a country. So I think it's starting by looking at the territory, the reason for the transaction, and then you've got to do a lot of work to try and identify the right entity. So it's a counterparty transaction identification process. So that's where it would start. And then from there, if you do that and you have a short list or an entity that you want to transact with, it's then, even from that stage, a very long process that you've got to go through. So from identifying the party, then trying to identify that the entity is for sale or will interact with you, engage with you, and allow you to engage. And then it would be negotiations, due diligence, contract closure, and a whole long process before that transaction gets concluded.
If you're looking to grow, Eloise, is the best route to take the joint venture route in terms of understanding the territory that you're going into, partnering with a local partner?
I think it depends, Bronwyn, on the industry that you're in and your strengths particularly. I would say if it is in the mobile industry and you are very confident of your ability, you have done this before in other markets where you have gone in, then it might be easier. If it's in the retail sector where really the consumer-driven behavior is key to your success, I would say very often if you can identify a local partner, that would be the correct way to go. If it is a big mining operation where there are no requirements from government to have a local partner, but you realize that there will be certain sensitivities, that's another consideration for taking a local partner on board. So it really depends from country to country, your specific expertise, and also the industry that you are in.
And Alan, a number of people who embark on this route would suddenly look at the tax regime and the differing tax regimes across the African continent and go, actually, this is far too complex for me to pursue. Do you find that happening a lot?
Well, I think, Bronwyn, an investment into Africa is essentially an economic investment, not an investment for tax. And very often investors are attracted by the returns they can get. And tax is really looking at it from the point of view is how can I make sure I get the maximum return from my investment into Africa. So yes, I'd look at it from a jurisdictional point of view, see what the taxes are in each jurisdiction, and essentially try to maximize the returns I can get out of Africa if I were an investor. And the kind of investment you're making, if it's a private equity investment, make sure that you're looking at the returns you get because you can get a deduction for interest. What kind of returns can I get after I extract the dividends out of that investment? So a lot will depend on the kind of investment you're making in the jurisdiction and what kind of legislative framework exists for the investment in that particular country.
Are transactions on the African continent the ambit of big multinational players with significant cash on balance sheet, or are small businesses starting to go alone in terms of saying there's a growth opportunity in Africa, how do I take advantage of it?
Bronwyn, we're seeing absolutely both of those happening. So it's a combination. Certainly you see the big multinationals now no longer ignoring Africa. I mean, so often, or historically, people were saying there was a risk in investing in Africa. I think we're now seeing people seeing it as if you don't invest in Africa, there's a risk. because this really is a new growth frontier. So it's on both fronts. You're seeing big global multinationals coming into the region, but at the same time, when we act, and even for small parties, we're seeing smaller entities seeing an opportunity that they can move and be nimble. And so it's not just the big multinationals, it's a combination of both.
Habil, let's move to Nairobi and get your opinion on what you're seeing in the financial services and banking arena when it comes to transactions that are being closed out at the moment. Let's get your view on the ground, so to speak, sir.
Yeah, thank you very much. What I can see happening in the local market is that banks are coming in to play a much more significant role. You know, one of the things that we have been trying to push for is the agenda of financial inclusion. And economic growth in this part of the region is mainly being pushed forward by the SMEs. And SMEs are some of the entities that are, so to speak, financially excluded. And so banks are trying to push forward their financial inclusion agenda to bring in the SMEs purely to grow the market.
One of the challenges, obviously, in the financial arena is that a number of these territories are overbanked. There are just too many players in country. Is that something that you're encountering on a regular basis, or your clients are encountering?
Sure, and I think one saw that particularly, say, in Nigeria, where there was a lot of banks, and from a regulatory perspective, they actually went in and started to make changes in legislation and forced a consolidation in that region. So that did happen. So there was a particular region that had issues. But the sense is, from an overbank, it's very attractive. So we're still seeing, our view is that there's globals looking to the whole African continent that haven't been yet to gain a foothold. And even the South African banks and other African banks are looking to have a full presence right across the continent. So there's still consolidation in the space.
Habil, throwing back to you in Nairobi, I think we need to get your sentiments on that front as well. John, throwing forward to the fact that we have seen consolidation in the Nigerian banking sector. Do you think we're going to see similar moves when it comes to the East African community, and that sense that right now, let's take for instance, Tanzania is sitting in a highly overbanked position?
Yeah, what I'm currently seeing is that there's a move by even the regulators to try to, for example, increase the minimum capital requirement for the banks, and that effectively will be a message to the banks that they may need to, for example, consolidate to be able to survive in the new environment. And so, if you are looking at, for example, the Kenyan market. Initially, the minimum core capital was 250 million shillings, but now it has been pushed to $1 billion by the end of this year. And there is a clear message that this may be pushed further up going forward. And so we possibly may start seeing a number of entities consolidating, and that was already been felt in the Kenyan market. In order to reach the $1 billion shillings at the end of this year, a number of banks have had to combine or raise capital from alternative sources.
With the higher capital adequacy requirements, and Alan, I'm going to throw this to you, do you think that it presents opportunity for international banks to come in and perhaps partner with a local bank and create that gravitas when it comes to balance sheet?
Well, I think that from the point of view of partnerships, we certainly have just recently seen a bank in South Africa going into Nigeria. Whether they're going to partner or not, that's going to be up to them to partner. What I would like to do, just in terms of the question you've asked me, Bronwyn, is to say that banks are going to have to look at the environment of the different jurisdictions and decide where it makes sense to come in and invest. Because we talk about coming into different jurisdictions. I'm just listening to the conversation here, and I think there's certainly some jurisdictions that are more attractive for banks to come into than other jurisdictions. So yes, there may be overbanking, but I believe that there's also a matter of talking of investing into Africa, but we've got to acknowledge that Africa is a huge continent with many, many different countries. And I believe that we've got to acknowledge that you can look at Africa sort of as an amorphous mass, But what we must recognize is each country has an attraction, and a bank wants a stable environment to invest into. We don't have a stable environment in every single country. And so I think banks are going to look at different countries and say, I'd like to come into these jurisdictions. They're more developed from a fiscal point of view. They've got legislation that's more attractive because it's more developed, and a bank looks for something more developed. A bank looks for a jurisprudential environment, in other words, which has a better legal framework. They're going to look for those and maybe partner in those kind of environments, and they're going to look for something where I think from a tax point of view, the administrative environment is more developed. Now, look across Africa, you'll find some that are really like that and some that are not. And that's where I think you're going to find banks saying, yes, I want to come in and partner, when that kind of framework is more in place.
Absolutely, and the terminology that we're throwing around at the moment is transition economies and pre-transition economies, to your point, Alan. So your transition economies, the likes of a Mozambique, Kenya, Zambia, and your pre-transition are where you've got that additional country risk and the political risk, and throw in Mali or Senegal. Would you agree with Alan on that point?
I fully agree. It's always a trade-off between risk and reward. Just following on Alan's point, for banks also there's an additional consideration: where are our clients? And that's an additional. So a client, and many of the opportunities on the continent are not necessarily in the most stable countries with the best developed environment. So while that is the ideal, if you only focus on those, then you may miss out on opportunities. You're not in the markets where there are huge resource booms currently undergoing. And I think the challenge, therefore, from a banking perspective, but also for other companies looking at the continent, you really have to understand what is the opportunity, what is my strengths, how do I best play to those, and how do I mitigate risks? Because every environment you are in will have certain risks. And what are acceptable risks in terms of the opportunity?
Shallow capital markets. This is a problem that plagues the African continent, and we certainly have this discussion in every conversation around Africa. What is the solution?
Well, I think it's a combination. Clearly you're seeing from the JSE in South Africa setting up an African market to try to attract and help companies in terms of raising capital through the formal capital markets. But I think we're also seeing an emerging sovereign wealth countries coming in to Africa. You're seeing the likes of China coming in with very different models to what we've seen in the past. So for big infrastructure projects that may not easily have been financed in the past, they come in with solutions and cheap finance, maybe for offtake arrangements. So I think we're going in through a whole new period. So there's the capital markets, there's countries coming in with solutions, with sort of turnkey solutions. And I think then you're also seeing that it has been difficult over the last 4 or 5 years with the financial crisis, and the cost of debt, cost of financing has been higher. But there does seem to be an improving sense of stability on the debt markets. And so it's not just the formal markets. I think each country would need to look to, to what market and how they can assist in the debt and fundraising potential. You've got private equity too that has a role to play in this, in helping companies transact as well.
Eloise, it looks as though you want to add there.
Yeah. I certainly think that it's very often the cost of debt that is the difficulty. Debt is available at a price. Our banking markets have developed. There's been a bit of a pullback in the last couple of years as a result of the crisis. But more and more commercial banks and other investment banks, not only South African or African, are getting an understanding of the continent, how it drives. It's not this, we are simply closed on country X. Most of the countries on this, if it's structured correctly, can access funding from a variety of sources. Private equity is increasingly playing. The biggest challenge, I would think, is for the long-term infrastructure projects, where we need tenors really up to 10, 12, 20 years to really make it viable. And that is where private equity cannot necessarily play a role. They want an exit in the shorter term. And that, talking to that point, that is perhaps one of the other challenges that we see, where a lot of greenfield opportunities cannot be accessed by private equity because of the problematic exit, because our capital markets and our equity capital markets specifically are not that developed.
The financial crisis of 2008 certainly set private equity back within the South African space. What did it do to private equity on the African continent? Did it manage to escape the negativity?
Well, I think private equity on the African continent is still relatively new. But what is happening at the moment is it's starting to gain momentum. There are funders that are very excited about the opportunities in Africa. What we do have in Africa, which is not as developed in South Africa, we've got legislation that's going that way, is we have thin capitalization rules. We are needing to look at whether the private equity investors can extract their funds from Africa, because that's a big deal. We do have controls, foreign exchange controls about getting the funds in, getting the funds out. So it's uncharted territory, frankly, at this stage, but it's developing. And, you know, funders are looking at it with wide-eyed. And they're saying, here's an opportunity that's untapped. And I believe over the next 5 years, instead of people concerning themselves with the old days or the wars that exist in Africa, there'll be wars about fighting for the opportunities that exist in Africa.
Habil, staying with this private equity story, are private equity players being embraced in the Kenyan environment or within the East African community?
Yes, we have seen quite a number of private equity fund players coming into the market. A number of them have raised funds and are trying to penetrate the market. A number have actually been set up, not just in Nairobi, but within the East Africa region. But most of them are somehow basing their base in Nairobi.
You wanted to add there, John?
I just wanted to add, just on this private equity space. There have been a lot of big South African private equity houses that have focused a lot in South Africa. But at the same time, some other big African-focused private equity houses, so the likes of an Actis that plays both in South Africa and across the continent, Helios, Aureus. And in this last few years, these entities have raised a lot of funding for the African continent. And you've seen traditionally or historically South African-focused private equity houses having to start and changing their mandates and looking at the African continent. So we think that private equity, whilst there has been a lull and for finance debt raising requirements or reasons, going forward, we actually think that's going to change quite a lot, and private equity will play out quite significantly across the continent.
Eloise, obviously we've been having this African story conversation on CNBC Africa for a long time now. And there was a time when we used to say, John referred to the Chinese and the money coming in from China. There was a time when we said, well, the Chinese are just after resources and they're going to get it at any cost. And there was a negativity, a pushback towards Chinese and perhaps also to India. Do you think that conversation's over? Now we're embracing what the Chinese can bring and that they can actually help improve the environment on the African continent.
We certainly see the Chinese investing not only in resources but also in infrastructure. They're building roads, they're building hospitals, they're building all over the continent. And I think from that perspective, there's certainly on the ground in Africa a lot more positive because everybody is benefiting. In Kenya, a lot of the roads at the moment are being built by the Chinese. It is in the same thing in Ethiopia, Angola, etc. So you have select pockets of resistance still. There may be negativity about how workers are treated in Zambia, etc., that comes up. But definitely, I think even businesses and other companies active on the continent are starting to see the Chinese as partners and investing in the infrastructure that is so critical to do along the whole resource boom, but also to enable, whether it's the power, the infrastructure that will really enable the growth that everywhere is forecast for the continent.
Are South African companies partnering with Chinese players and then conquering the African continent?
I don't think South Africa's taken the opportunity like China has. I can't answer the question of whether I know of South African companies myself that are partnering. But I would like to add something to the previous question. Might I do that?
John wants to take the partnering of the South African companies with the Chinese.
We have Standard Bank here that ICBC are a 20% shareholder, so there's a partnership we can talk to right away.
Why didn't you just bring me to that point immediately? It escaped me completely,
right, yes.
Of course, and completely remiss on my side, but you wanted to
But I did want to say that you can't dig a hole in the ground and get the minerals to the ports without building a railway or a road. So inevitably, you can't communicate without some kind of infrastructure. And so ultimately, you know, from the very mine all the way to the ports and the building of the port is infrastructure. It has to happen like that. And so the Chinese that are investing and might have appeared to be some kind of irritation that was robbing this continent are in fact developing as they go along. And this is what's going to happen in Mozambique as well with the discovery of the gas, coal and so on. How is it going to happen unless there are roads or railways that are built? It has to go hand in hand.
Habil, coming back to you in Nairobi as the Chief Executive Officer of the Kenyan Banking Association. Sir, are you spending a lot of time whining and dining Chinese players?
Actually, that's a very interesting debate that I was listening to as we were discussing it. I mean, there are 2 points I think I would like to add there. That one is that the capacity of the local players is such that some of the projects that are being implemented, especially in the Nairobi scenario, might be the size of the projects might be too high for the level of capacity available with the local players, and so. Even though they might sit and whine and complain about the Chinese invading their market and taking up the business, but I think the ability to deliver on the projects can be put to question. But 2, I think at the end of the day, they're not losers, because what happens is that as the Chinese take up these big infrastructure projects, there are other secondary businesses that are arising and falling along the line, and the local players are able to take those businesses that go along with the big infrastructure projects. So at the end of the day, it's, I think, a win-win kind of scenario, and that's where we see our support to the SMEs that are providing those secondary services becoming useful.
Hot button areas when it comes to transacting on the African continent. What are we seeing? Traditionally, we speak resources, infrastructure, oil and gas, the mining, obviously, environment linked to resources. The consumer play seems to be very big at the moment. What's the hottest area?
Well, I think you've touched on is we've really seen 3 mega trends, if you want to. One is around energy, natural resources, oil, gas, mining. I'd add agriculture into that, so food security is very big worldwide, so that's part of the natural resources. The second is consumer-driven demand. So you have on the African continent now an emerging, unprecedented middle class coming to the fore and now demanding goods. So, and that drives the retailers moving into spaces, the consumer goods, the Tiger brands, etc., moving onto the continent. That leads to the financial services players, the MTNs for telecoms. So that's the second one, and then the third one we've touched on quite a bit is the infrastructure space. So those are the 3 trends that we're seeing, and I think right now a lot of activity in that middle consumer markets-driven space. You saw Walmart and the Massmart transaction last year. You've seen Tiger Brands announce transactions in West Africa, and we believe there's more of that to come.
What transactions in what sector are you mostly dealing with at the moment, Alan?
The mining sector is no doubt one of the biggest.
So does it continue to hold center stage, mining?
Mining continues to hold center stage. The big issue for us, if I just hear what's going on, and I can't disagree. It's almost obvious that these things are happening. But I think there's an area that has to go beyond the mining, and that's the beneficiation, because at some stage questions are asked: are we in fact going to end up with a lot extracted? And then not a lot left. So that's obviously important, but we are dealing with those areas and issues around, is there going to be some sort of nationalism that we have to take account of every time there's an investment? And then, the other areas like the continent is growing with a huger number of people. By 2040, the number of people is going to double on this continent, it's suggested. So this is a massive quantity of people that are urbanizing, that potentially need to be, in fact need to be educated. So with that kind of demand, there's a capacity to supply services. And if we can just educate those people, we can have a lot of opportunity to supply services to the rest of the world, like India is at the moment. So it's outsourcing opportunity. And we've discussed, like we have, what the consequences are of outsourcing, and can we get ourselves to outsourcing opportunities. But from a tax point of view, it's the obvious things around what we're talking about in the mining area and retail and so on.
How are we dealing with this potential resource tax nationalization? Keeps making the headlines again, even in South Africa. And of course, this is a key concern for foreign direct investment into that mining space. Do you regularly encounter conversation on that front and the risk associated with it?
All the time. It's a big area. The issue is that I think it's probably more of a talking point than a reality. In most countries, there's some kind of nationalism, some kind of extra tax that's going to be applied. But at this stage, we constantly have forums with our clients, discuss what the issues are in the different countries. And we have specialists that deal with it all the time, economists and our mining tax specialists. But, you know, again and again, the issue is the returns are big enough to make it worth it to invest in these countries. And so the economics keep driving it. And that's why there's constant foreign direct investments into these areas.
Habil, we are going to be losing you in the next segment. So I need to get a sense of whether you think we are starting to look at Africa as regional plays. So certainly the conversation that I've been having more and more often now is that we're starting to talk about the East African community as one bloc, and it's starting to operate as such, and perhaps it's leading the way in terms of these regional plays. And then of course you've got ECOWAS in West Africa, you've got the Maghreb Union, which covers your Arab states, and you've got SADC, which covers your southern states. Is that the way forward, and do you think that you are leading the game?
Yeah, I think certainly it's taking root, and given the examples that you have mentioned, really, and where we in Kenya, where we belong with the EAC, I think that's the way forward. Because under the EAC, the members are really putting the measures in place to ensure that the EAC as a community survives this time. And eventually, I think they are really committed to making it a political federation as the ultimate objective. But currently, a number of them are meeting quite a bit of challenges, but meeting them step by step.
Habil, thank you so much for your participation and your insights, sir. And John, thank you very much for joining us. You're watching KPMG Africa Conversations, coming to you live from Johannesburg. We're taking a short commercial break. We'll see you on the other side. Welcome back to our KPMG Africa Conversations series, where we're discussing transacting in Africa. We still have in studio with me Eloise Smith. She's the Executive Vice President Business Development at Standard Bank. We have Alan Field. He's Head of Tax and Legal at KPMG. And we're joined now by Carl Smith, Africa Head of Energy and Natural Resources at KPMG. And joining us from our Nairobi studio is Segun Olujobi. He's the Chief Executive Officer of Vertex Energy. Thank you so much to Carl and to Segun for joining us for this segment. Just before the break, we were discussing whether Africa is starting to be seen as regional plays. Do you think that is the reality, Carl?
Yes, Bronwyn, but the one thing that we must remember, it's not only by geography. We have French-speaking Africa, we have Portuguese-speaking Africa, and we have English-speaking Africa. And that is also important in those regions.
Segun, I apologize, sir. Of course, you are in Lagos, in Nigeria. I'm losing my mind this afternoon. Just in terms of bringing you into the conversation, how do you feel about the strength of ECOWAS as a regional play when it comes to transacting on the African continent? Are people starting to come in and say, we want to do a deal within the West African region, or are they still very country focused, as in, I want to deal specifically in Nigeria, I want to deal specifically in Ghana?
I don't think it's an easy question to answer, and that's partly because officially I think it's the barriers, the countries are not quite as integrated as the ECOWAS charter would want it to be. Informally, however, I think you find that trade does move across borders, and you find that things that are produced in Nigeria find their way across the borders to other neighboring countries. So I think the answer is it's in between. I think people still tend to think country, but obviously a lot of trade happens informally.
Alan, let's get you to give your opinion here as well. Do you think that it is slowly in between that we're starting to look at regional blocks?
I think if companies are going to trade within a region, they'll access the opportunities that trading within that region makes sense. SADC, for example, will assist with trade within a bloc. But I believe that if there's an opportunity in an area that a company wants to invest in, they'll access that opportunity. It's not going to restrict. I agree that it's difficult to just put this in a particular category and say, because there's a block there, we're going to go into that block. It's just not how companies invest. If you're in a block, East African block, they probably will access opportunities. Remember the idea here, like the European Commission, it's designed to promote free trade. But there's no one investment that's exactly the same as another investment. Nobody's going into the European economy and saying, here's the European Commission, I'm going to go in there. It just doesn't make sense.
And perhaps the reality is also the regional blocks aren't integrated to the extent that perhaps we think they are.
Certainly, I think East African community, I have to agree with the previous speaker, is definitely leading the way in terms of also zero tariffs, which is ultimately what it is all about, and the free movement of people. What we see with many of our clients, they will look at especially South African companies that are looking to access the opportunity on the rest of the continent. They will broadly think the Southern African opportunity can perhaps be accessed from South Africa, whether it's a trade or a slightly into the BL nest countries, etc. Then they'll look at East Africa much more as a bloc, given the amount of integration that there is. The question then is, can you access Tanzania from a hub in Kenya? And should we go to Tanzania and then access the rest of the bloc from Tanzania? West Africa is a different conversation. I think especially for South African companies, unless it's resource-based, in which case you will follow where the resource is. If it's Guinea-Conakry, that's where you will go. But they will look at the West African opportunity, and the reality is just Nigeria by its sheer size dominates that market. And then they will say, maybe, and it's all perceptions with many investors rather than facts, they may think that Ghana is an easier entrant than in Nigeria, albeit they ultimately would want to be in the Nigerian market.
Segun, obviously in the first half we had a focus on East Africa and specifically Kenya with our guest from the Kenyan Banking Association. I think it's important, sir, to try and get your insights into what is happening on the transaction front in Nigeria. On the ground, what are the hot spots?
Well, I think traditionally, the hotspots have been oil and gas, because that's been the mainstay of the economy. But interestingly, in the last couple of years, I'd say in the last 5 years, oil and gas has actually been on a decline year on year for a variety of reasons. First, it was insurgency in the Niger Delta. Second, after that was resolved, was a lack of clarity around policy with the bogged down petroleum industry bill. So actually, growth has been more in the telecoms area. And the story about MTN is a well publicized story. But I think the story is more than MTN. I think it's been the old telecoms area. And I think it's the old consumer area. And that's because, for many years, the Nigerian economy was sort of mismanaged and not run properly. And each time you take or reform a sector, the pent-up demand in that sector just shoots up. So we've seen telecoms, we have seen some growth in retail. And so the hotspot has been sort of the telecoms, retail, sort of consumer goods area. Energy is big, but it's really on a year-on-year basis for the last 5 years actually been going down. So that's the way I'll characterize the growth of Nigeria and the things that have happened in Nigeria in the last 5 years.
Well, obviously your portfolio, sir, speaks to energy, gas, resources, and there, Segun just saying that we've seen the response in terms of energy perhaps diminishing and consumer focus is coming to the fore. Do you feel any pullback in the energy space? Of course, there's no conversation without Africa in terms of resources and oil and energy.
Bronwyn, this for me is really very important. Africa is so rich in minerals. You know, it is a fact that 30% of the globe's minerals can be found on the African continent. And whether we're talking oil and gas, with new discoveries daily, especially Mozambique, very exciting what is happening there. But if you look at the array of resources that you find in Africa, platinum, 80% of the world's platinum in southern Africa, manganese, gold, 50% of the world's gold you find on the African continent, 4% of coal. So what I always like to think and say, a resource-hungry world cannot ignore Africa. And why resource-hungry, Bronwyn? Population growth, urbanization. We need resources.
Earlier in the conversation, we spoke about tax regimes, about nationalization, and Alan was of the opinion, correct me, so if I'm wrong, that this is part of the conversation you have with investors that are thinking of going into the space. It's part and parcel. It doesn't come as a surprise. Do you reiterate those sentiments?
You know, Bronwyn, something that we have to get right on this continent is youth unemployment. You know, there's huge social pressures all over our continent to make sure that there's jobs and there's a future for our youth. And as long as we sit with those problems, I believe nationalization will be a discussion topic on the table. Whether that is the best way, that's another argument. But as I say, we see that all over the developing world, not only in Africa, we see those arguments in South America as well.
And I think that was the point that Alan made. We just had jumping the gun, our audience, on our questions, and Mark Zander saying, what is the potential of FMCG in Africa? Do you have any grasp on that? Again, it comes back to the consumer story.
It's a growing, you know, there's the trends, as they say, about Africa. One of them is obviously the resources. Around that, you have the power and infrastructure development. But then driving it all is really, we've got a growing population that's increasingly affluent. There's a lot of debate about how you define the African middle class, but you can debate about what the definition is, but the fact is it's growing. And it's increasingly urbanizing, which makes it possible for the FCMG growers and other service providers to get economies of scale, because you're increasingly going to have cities in excess of 10 million people on this continent over the next few decades. So it's growing phenomenally, and we're seeing this not only from there's the Walmart into Massmart, which is they're well talked about, but we're seeing increasingly regional players growing, increasingly in East Africa going across. So we see it's fundamentally, and that in itself drives packaging companies, service companies to the FCMG. There's a lot of talk about Nigeria, and what we're seeing is as people move up, there's the desire to have different products and perhaps just in smaller quantities. So it needs a rethinking. A lot of our FCMG companies need to say, we have a broader market, but we have to change our approach to that market and perhaps do single serving sachets rather than do the big 500 or 100 ml. That's no different from the telecoms industry, which has gone lower and lower into the denomination of top-up vouchers.
Segun, earlier in the conversation we spoke about Nigeria trailblazing when it came to consolidation in the financial arena, specifically among the banks, and cleaning up that business environment. Do you think that that is now starting to translate to other sectors? Obviously, your position at Vertex Energy. Are we seeing a cleanup of businesses across the board in Nigeria?
I think it's, I wouldn't say that's say that broadly. I mean, clearly banking, the consolidation has helped, and from a client perspective, I think we're seeing more banks being able to do more transactions at scale, given the sort of industry I work in. If I take power, which has been sort of the albatross of the Nigerian economy, I think we're seeing major reform in that area. Now, I think over the next couple of months, we expect some of our big Gencos and Discos to be sold off. I think if that happens, I think we would see a major effect on not just on the oil energy sector, but across the board. I think because of the population we have, FMCG will boom. I think services will boom as well. So I think that's one area we're looking at. If I go to oil and gas itself, I think with the petroleum industry bill now going to Parliament, it might take some time to resolve. But once that is done, I think with the right policies, with the right fiscals, and with a greater focus on transparency and competition, I think you'd see that boom happening as well. So I think we're poised, all things being equal, over the next 18 to 24 months to begin to see some real growth across not just banking, but across critical sectors like power, which drives FMCG, across energy and gas, which also helps to either add more money for the country or provide gas for power. So I think the transformation is going to extend beyond banking, but I think the key ones to look at is what happens to the generation sale, the sale of the discos, what happens to the oil and gas bill around, and what happens to the fiscals there. Does it make it easier for you to invest in gas? Are we going to see production volumes go up and reserves grow over the next couple of years? Couple of questions to look out for. Clearly, if the power reforms happen, I think we'll see significant growth. And if the oil and gas reforms also on the back of the new bill happen, then I think you might see a new Nigeria that's really living up to its potential over the next 5 to 10 years.
Carl, you indicated you'd like to add to that conversation.
Yeah, I think if we look at oil and gas, and if we look at mining on the continent, you know, investors want certainty. We want to be able to model and predict what do we need to put in, what are we going to get out. So policy is very important. And not only that, we need to make sure for investors that there's law and order in all the countries in Africa, because you at least want to know it's your asset that you're investing in.
Another question from our international webcast viewers, from Greg Knipe, saying, could he please get your views, and he's referring to all the panelists here, on the currency risk that we're dealing with in Africa. Who would like to take the lead on that one?
Can I make a short comment on it? I know, for example, that with exchange controls, you're investing in and what will you get out? And basically that's what investors are looking for now. Some countries in Africa, I think Kenya is a recent one, has recently changed or introduced exchange controls, and literally now you're investing in dollars and you're coming out in Kenyan shillings. Now that introduces risks. And so that makes, for an investor, introduces uncertainty that Coral's been talking about, that we've been discussing over here. So I think one of the things that investors and countries have to think about, and particularly the countries, is if we're putting money into these countries, we've got to make them as investor friendly as possible. In fact, between countries as well, we've got to become more investor friendly, because frankly, we don't really want the money to come into African countries and then get taken out again. We want it to stay there. And once we have exchange controls, once we have currency risks, it's a real problem.
Talking from a perspective of companies operating in the region, I couldn't agree more the appeal one could have to governments. The reality is, if you're operating on the continent, you are exposed to currency risk. There's an element of that if you are in the mining extractive industries. You then, since you are dollar revenues returned, you have a certain hedge. A company in the telecoms industry, for instance, to use an example, would be totally exposed. A lot of your inputs, your machinery, equipment, etc., will be hard currency based. You are importing this. However, your revenues, apart from very small roaming revenues, is local currency. And then it's a matter, how do you address that? Some companies, you can do it by matching your revenues to your debt, and therefore raising as much in local currency as possible. And this is where it's encouraging, where our local markets have really developed in many environments. And it varies greatly. A country like Nigeria, you can raise 250 billion naira in the local market for the right player. In a country like Rwanda, like Liberia, you have 5 banks, and each maybe has $1 million single lending limit. But really, so one aspect of it is to raise your money in local currency if you have local currency revenue. Increasingly, we have more exotic investors as well through a bank that can actually have appetite for Kenyan shilling risk, and therefore can be placed, albeit that you can't raise it in the local market, perhaps you can access it differently. And then it's really a conversation around your industry and your appetite for risk.
And of course, Carol, this is very relevant in your portfolio, where currency has a huge impact on the resources spectrum and the volatility therein.
Well, you see, most of the mining companies will sell their products in dollars. And that gives them sort of a natural hedge. I say, if you go and play in somebody's yard, you play according to their rules, Bronwyn. You know, if somebody come into South Africa to come and do business here, you do it in rand, and you write up your books in rand, and you pay your taxes in rand. We can't expect anything different from any of these other countries. So if we go and play there, we look at the risks and we see how we are going to handle those risks.
Segun, if I can come back to you in Lagos, another question through from Jim Maples saying, do the regulatory systems of African countries hinder transactions?
I think that's a very broad question. I'd say that from a Nigerian perspective, I think what I can say is that we're making progress to try and make sure that the policies are become more market-friendly, more transaction-friendly. And you've seen in the banking reforms that we've seen, you've seen the move towards even things like going cashless and using electronic banking. I think if I take the Nigerian perspective, the objective of the last 20 years of reform has been to make the markets more friendly to investment. Of course, we've done it in flips and flops. We've gone 2 steps forward and 3 steps backwards sometimes. But I think the general trend is that we do get it as a country and as a people. And I think that I speak for most countries. I think generally speaking, people have realized that the issue is about investment. Investments create jobs, and investment will not come if investors are shackled. So I'd like to think that generally that message is sinking in regulators, in businesses, in policymakers. And I'd like to believe, and I think so, that over the last couple of decades, Africa as a whole and Nigeria specifically has made progress.
Just a thank you to our international webcast viewers who are sending through their questions. We appreciate the interactivity. And of course, we also have a live audience here at KPMG in Johannesburg, and we're going to open it up to the floor as well. Do we have any burning questions from our audience this afternoon? We do so.
My name is Francis Osuya. I'm the Chief Executive of Frost Capital. The question I have for the panelists relates to indigenization and local content. Now, the question is this a trend, or is it a trend that is likely to spread across the continent? If it's a trend that will spread across the continent, I'd like to know how this can impact local growth and empowerment as well as job creation. Thank you.
Carol.
You know, we talk, Bronwyn, about resource nationalism, and this is something, it's a trend that we see globally. We want something to be left behind in our countries. We want to be part of this growth. And I think what we see happening in Africa is definitely an indigenization program. And I think we will see more of that globally and in Africa. And that is just one of the factors that you need to put into your model and see whether it kicks out the answer that you're willing to live with.
Anybody like to add to that answer?
Yeah, I think there's definitely, a couple of years ago, it was only if, say, in the telco space, there was a legislative requirement to have a 30% local partner that one saw that. Increasingly, I think there's a realization by investors of the value that local partners bring. I'm pleased to say that Standard Bank were recently involved in the funding of one of the first indigenization in the oil industry in Nigeria as part of that program. So again, that creates an opportunity in itself.
We have another question from our audience.
Thanks. Almost related to, my name is Lebu Malatleha. Almost related to the previous question, I know we've been talking investors, but it looks like we've got a lot of investees in the room. Alan, you mentioned that we don't just want money to come in and then leave Africa. We want it to stay in Africa. Exactly how do we achieve that? Can you just give me a practical example of how we achieve that? How do we advise our investees to make sure that they get value and they remain with value in Africa?
It's really a related question. My name is Tsidi Mokabudi from KPMG. I just want to understand, you spoke about the shifts that you are also seeing, whereby there are new developments in some countries like Uganda of the natural resources and so on. I want to know, to what extent then is the FDIs following those type of shifts and trends? If they're not right now, what's your view going forward? Are the FDIs really still following the so-called gateways in terms of South Africa or Nigeria, the big ones, or are they following where these new developments are happening?
Sigun, can I get you to comment on this? Is FDI following the hotspots in Nigeria? And then I'll bring it back to the panel here in Johannesburg.
I'd say absolutely. I mean, if I start from telecoms, FDI, MTN has put quite an amount of money in this country over the last couple of years. They've done that because they've seen returns. They've seen that there's potential for returns. After MTN, we've had Etisalat come in recently. So that's just an example. If I take the oil and gas sector, for example, when the policies were right in 1993, when the first set of PSCs were signed, investments rushed in. In the last couple of years, investments are slowed down because the last couple of PSCs that we signed were not quite as attractive. And the last couple of years, with a lack of clarity on policy, they slowed down. If I take East Africa, for example, because the policies have been right, because the fiscals have been right, you've seen money pouring into Mozambique, into Tanzania, into Uganda. Mozambique, there's estimates say between $20 and $50 billion are going to go into that gas find. Almost 100 TCF of gas found in the last couple of months or year or two. So I think investment is going after real opportunity. The truth about it is that we're well positioned. The rest of the world is slowing down. Europe is in crisis. The US returns are low. It's only Asia and Africa where the returns are there. And if you take resources, if you take oil and gas, for example, Africa has one advantage in like all the minerals, but oil and gas specifically now, that this is the most open continent. Our NOCs are not as strong or established. The continent is still open, so you find, and we're close to Europe, which is a growth market. We're close to the Atlantic, and on the eastern side now, yeah, we are growing. So
my apologies.
Is growing there.
My apologies for interjecting. I'm just cognizant of time. I've got 4 minutes to the close of our conversation. I want to bring it back to Johannesburg and answer the first part of the question: how do we keep the money in Africa?
All right. I think the one important thing is investors want to have a secure investment. They do not want to lose the funds. It must be more attractive for them to keep their funds here than to take it out. And I think in many jurisdictions you find that some of the things from a tax point of view may make it unattractive. Security comes from the fact that they must know that in that environment they have the frameworks that we spoke about earlier. I heard just yesterday about a 20-page tax legislation in a particular country. Now, you know, it's just crazy. Why would you keep your money there when you don't know what the government's going to do in the next 5 years? When you don't know what and I'm talking legislatively, when you don't understand how the regulatory environment's going to look, when you don't know the legislative framework, and I'm talking beyond tax. Tax is just a slither in that framework. So we need to make it more certain. And typically, it's safer to keep the money where the whole environment is more developed than where it's uncertain. And so we can't force investors to do anything. What we can do is what the African tax environment, the African tax ATAF is doing. It is working with the different governments to try and develop a platform of tax environments where everyone is working in a much more equivalent tax framework. And I think that would assist.
It comes back to your point earlier in terms of certainty. We have got 1.5 minutes to the end of our conversation, and Julia Briefs has come up with the perfect question, which you all need to answer, and you all need to answer it in round about 30 seconds, including our Nigerian guest, Segun. Segun, I'm going to start with you. Julia Briefs saying, if you had $100,000 to invest on the African continent, where would you invest it right now? Segun, starting with you, then we'll go through Carl, Alan, and Eloise.
I'll be looking to put it either in Mozambique or Tanzania.
Very nice short, sharp soundbite there. Thank you very much for following my instructions so well. Carl, from your
When
perspective.
the textbook says split your risk, I will not split it. I will go for Mozambique with their gas discoveries and with their coal discoveries and with the development of their coal fields. I think it will be a very safe bet.
Can we get more takers for Mozambique? I feel like I'm going to be auctioning off the countries here.
If I had $100,000, I wonder where I got it. But, all right. But having said that, I'm going to be patriotic, and I'd put it in South Africa.
Like that patriotism.
I would go in a sector rather than and I would put it in the agribusiness sector, because I'll have a long-term view, and I believe that's one of the sectors that we don't pay enough attention to.
Just very quickly, to that point, are we seeing people really delving into the agri sector? We've got about 20 seconds.
We are seeing it. Perhaps more on the, you know, the agri sector goes all the way from farm to fork. We're seeing more at this point in time closer to the fork in agribusiness rather than perhaps emerging farmers, but definitely a growing area.
Thank you so much all for your time, and I think on that note it brings us to a close with the KPMG Africa Conversations series. We've been addressing transacting in Africa. Thank you so much to all my guests, and of course to Segun in Lagos in Nigeria. Thank you for your time and your insights, sir. Thank you so much to our international webcast audience and also to our live audience here in Johannesburg at KPMG. That's it for the KPMG Africa Conversation series. Until next time.
Ladies and gentlemen, thank